Capital maintenance. The doctrine of capital maintenance is one of the fundamental principles of company law. It is based on the concept that the share capital of a limited company serves as a buffer fund for creditors, providing assurance that a minimum level of assets will remain available to satisfy corporate liabilities. Since shareholders benefit from limited liability, the law restricts the circumstances in which capital may be returned to members, thereby protecting those who extend credit to the company. As a general rule, a company cannot reduce its share capital or purchase its own shares, either directly or indirectly, because doing so would diminish the financial protection available to creditors. Nevertheless, the Companies Act recognizes that commercial circumstances may justify a reduction of capital, provided appropriate legal safeguards are followed. Under Section 641 CA-06, a company may reduce its capital for any reason and at any time, subject to compliance with the prescribed statutory procedures. Three principal methods of reduction are recognized. First, the company may cancel liabilities on partly paid shares, effectively releasing shareholders from their obligation to pay outstanding amounts. Secondly, the company may return excess capital to shareholders, reducing corporate assets where the capital exceeds operational requirements. Thirdly, the company may cancel paid-up capital that is no longer represented by assets, allowing accumulated losses to be eliminated from the balance sheet by writing them off against share capital. These mechanisms improve financial restructuring while preserving legal certainty for creditors and investors. The procedure for reducing capital differs between public and private companies. Public companies must first pass a special resolution, after which an application must be made to the court seeking confirmation of the reduction. Where the reduction involves cancellation of unpaid liabilities or repayment of capital, the court must settle a list of creditors entitled to object and must be satisfied that their interests have been adequately protected before approving the reduction. Following approval, the company must file the relevant documentation with the registrar. If the reduction causes the issued share capital of a public company to fall below the statutory minimum of £50,000, the company must re-register as a private company. Private companies benefit from a simplified capital reduction procedure. Instead of seeking court approval, they may reduce capital by passing a special resolution supported by a solvency statement made by all directors. The solvency statement confirms that the company will be able to meet its debts during the following 12 months. Copies of the resolution, solvency statement, and statement of capital must then be filed with the registrar within 15 days. Directors who make a solvency statement without reasonable grounds commit an offense and may incur criminal liability, ensuring that creditor protection remains paramount despite the simplified procedure. The chapter also introduces treasury shares, which arise when a company purchases its own shares from distributable profits. Rather than canceling the acquired shares, the company may retain up to 10% of its shares in treasury, enabling future reissue without complying with the usual share allotment formalities. Treasury shares provide flexibility in capital management while remaining subject to statutory capital maintenance rules. Debentures. A debenture is a document issued by a company that acknowledges its indebtedness, whether or not the debt is secured against company assets. Unlike shares, which represent ownership interests, debentures create a creditor relationship between the investor and the company. Companies generally possess an implied power to borrow money for business purposes, making debentures an important method of raising long-term finance without issuing additional share capital. Debentures possess several significant advantages from the company's perspective. The board of directors generally does not require shareholder approval to issue debentures, allowing management to obtain financing efficiently. Since debenture holders possess no voting rights, issuing debentures does not dilute existing shareholder control or alter ownership structures. Furthermore, interest payments are deductible before tax, reducing the effective cost of borrowing compared with dividend distributions, which are paid from post-tax profits. Debentures may also prove less expensive than equity financing and may be issued or redeemed without the statutory restrictions applicable to share capital. However, debentures also involve important disadvantages and financial risks. Interest constitutes a contractual obligation that must be paid regardless of the company's profitability and may need to be financed from capital where profits are insufficient. Failure to meet interest or principal repayments may trigger liquidation or administration proceedings, particularly where the debenture is secured by company assets. In addition, excessive reliance upon debt financing increases financial gearing, potentially reducing investor confidence and adversely affecting the company's share price. From a legal perspective, debenture holders occupy the position of creditors rather than members of the company. Consequently, they have priority over shareholders in the event of liquidation and enjoy contractual rights to interest and repayment that are independent of dividend policy or distributable profits. This priority significantly reduces investment risk compared with ordinary shareholders but excludes participation in corporate ownership or voting rights. Overall, capital maintenance rules preserve the integrity of corporate share capital for the protection of creditors, while debentures provide companies with a flexible source of debt finance that avoids dilution of ownership. Together, these legal principles support effective corporate financing while maintaining an appropriate balance between commercial flexibility, shareholder interests, and creditor protection under modern company law.